Okay, go ahead, please.
Okay, we spoke about specific cost of capital where we talked about the asset beta, the equity beta, where we said asset beta measures the business risk of an organization of a firm, while equity beta measures the business and financial risk of a firm. Then you talked about when a firm wants to venture into another, as is it another industry or something like that, that we have to take the you have to look for a proxy company, then the gear and on gear. If their beta is an equity beta, we have to de-gear to remove the financial risk of the business, then gear back with the financial risk of our own firm. Then we try to solve some questions on how to gear and ungear beta. Yeah, that is what I can remember, sir. Thank you.
That's fine. You're welcome. Do we have anyone that want to actually do we have anyone that want to actually add to what she just said?
Yes, sir. Good evening.
Okay. Yeah, good evening.
So, concerning the procedures for calculating specific cost of capital, under step two, you gave us two formulas and you said that we should use the first one when the BD is not zero. So you gave us two formulas and you gave us this plus sign. So I just wanted to like make a clarification that that plus sign is not supposed to be or, since they are two different formulas, because I believe when some people visit the video they would mistake it to be one formula, not knowing that one formula works when BD is zero and one doesn't work when it's not zero. I don't know if you understand what I mean.
Yes, yes, I do. Like this, that this is supposed to be all. Like this one's
Yes,
supposed to be all.
yes, that
No,
plus. No, this
this
plus when you
this
move
plus.
here.
No. They are together like this, right? It's one formula. This is the formula actually. This is the formula, right? But you can only use this first one if the beta depth is equals to zero. When you look for the beta depth of the proxy company and
Mm,
is equal to zero. So when it is equals to zero, that means that you will just use the first formula because
mm.
all those things by the right hand side will become what zero. Do you get?
Yes, I get. So what you're trying to say is that when it is not zero, that's when we use the two.
Yes, that is when the beta depth of the project company is not zero.
Okay,
So we have to
okay,
is they are together. Is not all.
okay, okay,
Yeah.
okay. Thank you. Thank
Welcome. So do we have anyone that have question? Ask question. Okay. So we'll look at this question, right? We'll look at question one. Check your material. Question three. I think this question should be. Oh, this question should be. This is a question. I think it should be or past question actually. I don't know, but then
Sir, the material has not been given to us, sir.
as how now. Oh. That's true. That's true. Apology. I thought it's cost of capital. Apologies. Okay, let me quickly add it now. Oh, I thought it's cost of capital. Some of these questions, we may not solve some of these questions until we treat. We need to treat bond valuation. We need to treat their standard questions. We need to treat board evaluation. Okay. Okay. So let's just use this like this. Please, I'm sending it to the drive now so you can have access to it. Updated. Okay. Please, you can check your material. Apologies. I thought I've sent it right. Apologies, apologies, apologies. So you can check the Google Drive. You will see risk adjusted cost of capital. So please, what is another name for risk adjusted cost of capital? Should in case the examiner says, oh, maybe it is not risk adjusted cost. What is the other name for risk adjusted?
Project
Project cost of
specific cost
capital.
of capital.
Project specific cost of capital or appropriate specific or appropriate cost of capital, right? Examiner may say, oh, appropriate cost of capital. I remember vividly that I gave assignments on I think cost of capital, the other one that does not include risk actually. So I will mark it, I will check one or two immediately after the class. Right. So okay, let's quickly check the required of this question. Using class, are we good?
Yes, sir.
Hello? Okay. Yeah, okay. So please just check. So required using the capital asset pricing model, calculate ZECO PLC current cost of equity and a project specific cost of equity suitable for the what? For the new venture. Can you see the required? The required just say calculate using CAPEMO, calculate the current cost of equity. That is the current cost of equity that will not include any risk. Just calculate your normal cost of equity, right? And a project specific cost of equity, meaning that after you've identified the project company, you regear, right? Then you regear, let's say you remove the financial risk of the project company to calculate your asset better. Then after that, you calculate your equity better by including the financial risk of the main company, the business risk of the company of the similar industry you are diversifying into, and the financial risk of your own company, right? Thereafter, you calculate what? The cost of equity. That cost of equity is a project specific cost of equity. It is because it has already included both business risk and the financial risk, right? So therefore, so you just need to like stop when you get to the project, when you calculate the in some question examiner can say, oh, risk cost of equity or anything, but you should know that your cost of equity should include risk, right? So this is 6 marks, right? This is 6 marks. So referring to your calculation above, comment briefly on the view of the commercial director. What is the view? We will see most of all these things, argument as we move. You will see most of all these arguments between the finance director and probably the chairman and the finance director, oh, you should use this. The chairman will say use project specific cost of capital. The finance director will say no. The chairman will say use cost of capital without risk. The finance director will say use project specific cost of equity. So project specific cost of capital to discount the project. So the two directors were like, oh, okay, on this argument, what would be your advice? Right now, and let me quickly tell you something, that when you use a cost of capital that does not include a risk to discount a project, that project, most likely the project will have a positive NPV because it does not even include any risk. You've not factored in risk, because when you adjust for risk, definitely some projects that is positive NPV may end up having what? A negative NPV. If you have a positive NPV using the normal cost of capital to discount, maybe 5%. When you use a project specific cost of capital to discount, it may give you 2%, because that 2% is actually good than having 5%. Okay, you convince me that I should invest in this project. I've invested in the project, a capital project. I've invested in the project, and you tell me that, oh, IB, don't worry, your return on investment is 3%. Let's say total is 3% because you've calculated, do your analysis, all those Excel, you've done it. Now say, oh, 3%. And that 3% exclude the risk. Then at the end of 1 year, and I say, oh, IB, you know what? It is not 3%. Will you come back to me and say, oh, it is not 3%, so it's 2% because of the exchange rate, because of economic downturn, because of this, right? So as an investor, as an investment analyst, or as an investment banker, you should be able to consider this risk in your words when you are discounting the project, so that you already know this is after. Even if it is subjective, you will know that, oh, this is afterwards, after you've taken consideration of the word of a risk. Right. Now discuss three problems ZECO may be facing as a result of its current high level of gearing. Now, a company that has an high level of gearing, what will be the problem the company will be facing? Right? What will be the problem? Is that also what will be the what? What will be the problem? All right, 6 marks. You'll be the one to answer this, right? In respect of both equity and debt, discuss the risk return relationship and how it affects what ZECO PLC finance. So they want you to tell us about equity and tell us about debt. Tell us about the return on equity. Tell us about the return on debt. Tell us how, if we go for equity, what will happen to the finance? Oh, tell us, if we go by debt, what will happen to the capital structure of the company class? And this is 6 marks, right? This is a very standard question. Actually, it's normal question. It's not even standard. Let's say normal question, actually. So now, the first required is to using the capital asset pricing model. Is that not so? Now, the question now, ZECO PLC is a listed company, right? Is a listed company in the house contribution industry. Over the past 5 years, results have been disappointing, and as a result, the share price has fallen from a high of 3 naira 50 kobo per share 5 years ago to only 1 naira 05 per share per day. Class, the things have been going well with the company, right? Things have actually been what? So, so the result has been disappointing because their share price has fallen from 3 naira 50 kobo per share 5 years ago to only 1.05 naira, right, per share today. You can see the current share price is 1 naira. Before it was 3 naira. Now, what could have happened? What could have led to the deterioration of the market price? Now, the deterioration in the performance and the share price has been accompanied by an increase in the financial gearing to a high level. Of course, a company that has high level of gearing, what will happen? Their market price will fall, because as an investor, you will not want to invest in that company because they will first of all settle the debt holder. That is why in the profit or loss account, you will have earnings before interest and tax, earnings before tax. You remove interest. So these are the things investor will look at when they want to do what? When they want to invest in that company. They'll have high level of gearing. Let me quickly on, because my return, I may not have high return because they have to settle the debt holder. So that is one of the reasons that may cause a falling in the what, a reduction in the what, in the market price. So we're given the financial information, the share capital, the long-term irredeemable, and all that. Class, ZECO PLC loan notes. ZECO PLC loan notes are quoted at what? At 65 naira per loan note. Class, when they say something is quoted, that is the market price of the loan, is 65 naira per loan note. And both the loan note and the bank loan are secured. Now, there is a topic we are in February already, right? We should move fast. There is a topic in SFM, capital reconstruction and reorganization. We'll get there. Maybe my Oga will take that part, Mr. Razak. Capital reconstruction and reorganization. We'll get there, actually. We'll get there. Now, ZECO PLC equity beta is 2.3. Class, when an equity beta is 2.3, is greater than 1, what is the implication? Let me just mention that here. When equity beta is greater than 1, what will be the implication? All these things are just 2 marks. 2 marks, like 2 marks question. When equity beta is less than 1, what will be the implication? Now, when equity, let me quickly mention it. When we get to portfolio theory, I'll still mention it again. When you have an equity beta that is greater than 1, what does that imply? It means that the company's stock the company's stock has a very high risk, or we could say the stock, the higher the risk, the higher the return. We could say, the company's stock is risky because it is greater than 1. That is just what you just need to say. Because it is risky, it is greater than 1. That means the return will be higher, because the higher the risk, the higher the return. But when equity beta is less than 1, what does that imply? It means that company's stock, right, is less risky, meaning that there is no much risk attached to that stock, because it is actually less than 1. So some of these questions may come maybe 2 marks or 3 marks question, right? Now, new venture to improve performance. ZECO PLC is considering the construction of commercial properties. Class, you can see what is their main line of a business before. What is their main line of a business? Let's check. They are into construction. Now, they are into what? House construction industry. Now, they want to go into what? They want to go into what? The construction of what? commercial property. Now, they are diversifying. So that should come to your mind that, there's a purchase specific cost of capital, even from the required of the question. So when you read the required, the first thing after the required, the second, what should come to your mind after that is, what are the steps? So when you are reading the question, you are reading with the mindset of bringing out those ingredients from the question. Now, considering the construction of commercial properties, such as office blocks, and industrial what? Complexes. Now, this is a new activity of ZECO PLC. Yes, we know. And it is expected that the risk involved will be different from its current activity. Of course, I'm into construction. The first one is construction of what? This is construction of what? Properties. They have to go and check a similar company that is into that construction of properties as a proxy company. They want to know the business risk of that particular sector they are diversifying into. So the finance director, the argument now, the finance director has proposed that a project specific discount rate, another name that they can say, project specific discount rate, should be used to appraise the new venture. But the commercial director does not believe this is necessary. You can see the argument. Plus, SFM is very simple. You don't need to cram it. See, if you understand all those things, this is an argument between the financial director. But technically, practically, let's look at it. You want to go into another line of a business, and you are telling me that, I should not use a project-specific cost of capital to discount the project. There will be a problem on that investment. But the commercial director says, no, it is not necessary. You, as a finance director, as an expert, you have to explain to the commercial director. Now, color commercial property. This should be class. The color commercial property PLC undertakes commercial construction projects similar to those being considered by ZECO. Class, KSP is what? Color commercial property is what?
A
Proxy
proxy
company.
company.
The proxy what? The proxy company. KSP has an equity beta. There is an equity beta of 1.25 for the proxy company. KSP has 100 million of ordinary shares in issue for the proxy company. The current quoted market price, this is market price, 2.60 naira per 1 naira nominal value, ordinary shares. The company also has 110 million of loan notes issue, currently quoted at what? At 96 naira per 100 naira what? Nominal value. Can you see the information for the proxy company? Both companies pay tax at 20%, meaning that both have what? The same tax. The risk-free is 4%, and the expected return on the market portfolio is 10%. This is risk-free. This is market return. Right? This is risk-free, and this is market return. So the first required is to calculate using the capital asset pricing model. We should just calculate the normal cost of capital, the current cost of capital without risk. What with the usual that we know, KE, but we want to, then we will now do what? We will now determine a project specific cost of suitable for the what? For the new venture. 6 marks. 3 marks, right? 6 marks. Now, Mr. Victor, do you have a question?
No, from my end.
Okay, okay.
Thank you.
Please, can you put down your hands? Yeah, I think I'm just saying something here. Okay, 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 okay. Good, good. That's fine. That's fine. Okay. So if you want to get the material, actually, you can reach out to Christy. Please don't send me DM for material. I can block, except my sugar mommies, my babies, so they can send me DMs. So any other person, don't send me DM. So it is what it is actually. So now, suggested solution. Suggested solution. Suggested. Please confirm if you can see my screen or suggested solution. So what is the name of the company? The main company? Zeco. Please, I'm sure you are with your material, right? Very important. So Zeco PLC. Check question 3. Check your Google Drive. You see there. Right? You see Zeco PLC. Right? You see Zeco what? Zeco PLC. So after that, we need to determine A, the cost of equity. A, we need to determine the cost of equity, the main cost of equity, the current cost of equity, right? So current costs of equity. CAPM. Please, can you mute your mic? What is that now? Please mute your mic. Thank you. Okay. So what's our formula for calculating cost of equity? Let me quickly copy the formula, right? We don't have that time. Okay, where is it? So without risk, excuse me. This is the cost of equity. Now, let's check from the question. Are we given risk premium or risk market return? I think we're given market return, right? Risk-free is given as 4%. The market return is given as what? The market return
10.
is given at 10%. What is the equity beta of the main company? What is the equity beta?
2.3.
2.3.
2.3. Thank you. Please, I beg you, I'll make let me beg you now. Right? I'm begging now in the name of anything, right? You know, if you know you want to chat with your boyfriends and sugar mommies and everything, you can do that after the class. In fact, you can do like me. I actually block them. So immediately after the class, I will unblock all the, they will continue the conversation. So please, I want you all to pay attention to my explanation. Very, very important. Very, very important. I used to say something that when the desirable is not available, available becomes the desirable. Meaning that what you expect, it changes. Then you can now say, okay, you fall back to what you know. And that is what happened last diet in SFM. The question, right? In SFM, what? Question. Please. Now, the risk-free, what is the risk-free? How many percent?
4%.
Well, 4. What is the equity beta of Zeco?
2.3.
2.3. What is the market return?
10%.
10 minus 4. What is that now?
Jennifer Maduka, please.
Okay. So what do we have? What do we have as equity? Cost of equity?
2%.
I mean,
18%.
18,
17.8.
17.8%.
17.8. Who is that now? 28, 17 point what? 17.8%. Right? The question did not say we should calculate WACO. The question just said calculate the current cost of equity. And this is the current cost of equity. And a project-specific cost of equity. Now, project-specific cost of equity. Project-specific costs of equity. Right? Project-specific cost of what? Cost of equity. Step 1. I'll identify the proxy company. Proxy company. The proxy company is what? KSP, right? KSP. Color Construction Properties.
KCP.
Okay, KSP. Okay, KSP. Okay, KSP.
KCP.
Okay, KCP. Sorry,
KCP.
KCP. That's fine. Step 2. Step 2 is for us to
Okay.
yes, it's for us to remove the financial risk. If you don't know the gear or gear, just say remove the financial risk of the proxy company. That is, calculate what? Assets better. Class. That is, calculate what? Assets better. If you know, you don't know if you know, like, just use something that will be very easy for you to understand. This is how I understand it. You can modify it, right? So this is the formula, right? So that we're left with the business risk, which is the business risk in that sector, which is the construction of properties, right? Construction of properties, commercial properties. Now, all of this information is for which company? Class. All of this information is for which company?
For proxy company.
Proxy.
Is for proxy what? For the proxy company. Right. Now, let's check. Is better debt of the proxy company, is it given to us in this question? BD
No.
of the proxy company. Can you see?
No.
There is no any information here. We've read it. We've read that together now, right? There is no information about the better debt. So therefore, all of this will be equals to 0. Then we'll make use of the first one, right? So we'll go with the first one. All right. We'll go with the what? With the first one, and so we move from there, right? So BE, which is the equity better of the proxy company. What is the, let's check. Equity better of the proxy company. So what is the equity better of the proxy company, class?
1.25.
1.25.
1.25. Let me highlight it before. 1.25 is even greater than 1, right? 1.25. So value of equity, value market. I hope you still remember how we calculate market value of equity, market value of debt under the normal cost of capital without risk, right? Market value of what? Of equity. Ideally, the examiner is supposed to give us in percentage, so that we say, hey, market value of debt is this, market value of equity is this, the usual. But the examiner wants to test your knowledge, whether you understand how to determine the total market value of equity or debt. Don't forget how we usually calculate it under the what? Under the cost of the first part of cost of capital. Now, how do we determine? The first one is market value of what? Market value of equity. Now let's check. KSP has ordinary shares, 11 million ordinary shares in issue, currently quoted at what? 2 naira 60 kobo per what? Per 1 naira nominal value of ordinary. Can you see the current quoted price? That is the market price, right? But we don't know if it is Kumdiv or SD, but we don't know. We assume that it is what it is given to us, right? You can see that it says currently quoted. That is the market price, right? And the value of ordinary shares is given to us in this question to be what? 100 million. The nominal value is given to us as what? 1 naira. If I divide 100 million divided by 1 naira, it will give me the numbers of shares. Is that not so, class? Is that not so? Is that
It's
not
so,
how
sir.
we usually calculate it?
Yeah.
Yes,
Yes,
sir.
sir.
Yeah.
The value of ordinary shares divided by the nominal value times the market price. And we say the market price is SDIF. So definitely the currently quoted price given to us should be the SDIF, right? Should be what? The SDIF. So therefore, let me still write it. Let me still write it. Market value of equity equals to the value of ordinary shares divided by the nominal times the market value or the market price per share, or market price as div. It should be as div. Let me just add it as div. Yes, because that is what is used usually to calculate what? The value. So the value of equity is 100 million divided by 1 naira times what is the market price, class? What is the market price?
2.60.
Naira.
Okay, 2 naira 60 kobo. 2.6 per share. So what is the value?
260.
260 million.
Yeah. Good.
60
Class,
million.
you can see that this is different from the usual market value of equity. They will give us debt to equity, debt to this. This is the second part. Like, this is another approach at which question can come when you want to determine your market value of either equity or debt. It can come in form of percentage, or you have to determine the value, giving you your market price, the currently quoted price. That is the market price, right? That should be SD, right? We'll assume that. As I think the question says, and state your assumption. I will just state our assumption. Assumption is allowed in finance, even generally. Yes, it's assumption. But your assumption should be based on fact. Not that because this one increased, then definitely this one should increase by 2%. On what basis? Right? On what basis? So if this is established, this is the market value of equity. So what will be the market value of debt? Market value of debt. Let's check. Right? Okay. The company has on 110 million of loan notes in issue, currently quoted at what? At 96 naira per what? 100 naira nominal value. Can you see? All right. So we do the same thing with that. So we can have here value of debt divided by, now this value of ordinary shares. This value of ordinary shares. Okay. No, let's move on. So the value of debt divided by the nominal value times the market price as interest. That should be the current quoted price should be an as what? As interest. So we have 110 million divided by 100 times, what is the market price currently quoted?
96.
96 naira. 96 naira per bond. To be per bond. So what do we have? What is the value? What is the value?
105.6 million.
105
5.6
million.
6 million. That's fine. Okay. We are done with this. The value of equity and the value of debt. We're told that the tax rates remain the same, meaning that both have the same tax rates. What is the tax rate? 20%, right?
Yes, sir.
We have
Sir, please,
20.
is it 6 naira per bond or 96?
Okay, 96.
Okay.
96. And we're told that both as what? They have what? The same words. Sorry. They have the same
The
words.
same tax. Abi?
The same tax. A minute. Where is it? Okay. So, please, we have SFM on Sunday. Now is back-to-back lecture. We need to speed up. We have a lot to cover, but it's nothing actually. So don't forget that I will cover
What time
85 minutes. You said, check the timetable.
Time on Sunday.
Yeah, check the timetable. Is it not?
Actually, 9:30.
Is it 9:30? Which 9:30? Which is 9:30? Are we 8:30?
It's 9, no, 9.
Uh-huh.
9?
Yes, 9. Ah,
Oh, okay, it's 9. Okay, yes,
9
yes.
to
It's 9.
10:30.
Yeah, okay, yes, it's 9. It's 9. Ah, come on. Okay. It's fine. It's fine.
Ah, the
So,
match lecture morning from 1 o'clock to the 3.
oh yeah, now
Hey,
continue.
yeah.
So the BE 1.2 they play. VE is 260. I can actually do it.
1.25.
Okay,
BA is 1.25.
1.25. Okay. This is 260. Value of debt. Why we have debt. But why? I know the question is somehow you look at it, this question is simple now. But there's one thing examiner wants you to do here. Not in this part, actually. Maybe in the other step. Right? So what do we have? Just give me the final figure. So that we move, please.
0.94. 0.34, sorry.
0.34. Okay, 2 decimal. We have to be consistent. If it
0.94.
is 3,
0.94, sir.
94.
0.94. So this is step 2. Step 3. What is the next step? Step 3. We should do what? We should include the
Review.
financial risk of the what of the main company. So because you have to include what the company is actually facing, the risk at which the company. Another sweet question that the examiner may ask you, like when you see it, it's just 3 marks, you quickly chop it, like you move on. You take that 3 marks out of 50, take 3 marks first, right? Is the financial risk, business risk, systematic, all those things are just like 6 marks, I think 4 marks questions. Right. So please, very important. So when you are giving the explanation, when you are explaining on all those things, you should state like maybe 1 or 2 examples, right? Now, BA, we should not forget that all these parts is for the what? Is for the main company. Why this is for the what? For the prosy what? For the prosy company. So let's check. We need to check for better debt of the main company. We need to check the value of debts of the main company. We need to check the value of equity of the main company. We need to check for the tax rate of the main company. We already have this. What do we have as BA? 0. What? 0.94. Good. Now, let's check the better debt. Where is better debt? Okay, for the main company. Right. All of this information is for market price. Okay. Better debt. Are we given anything better debt? No. Any better debt? No better debt. So that means that the better debt will be equals to what? 0. Is that not?
Yes.
Better debt is this. The next thing is the market value of debt. Are we given the level of gearing of debt to equity ratio, all those things? I don't think so. Let's check if we have to determine the total value. Okay. What do we have? Where is it? So we're given there is market price, right? Market price, the current market price. So if there is current market price, that means we can determine the market value. Is that not so? Of equity. So therefore, what is the should I start with debt? Okay, let me start with debt, or let me start with this. So what is the value of ordinary shares? Value of ordinary shares is given to us in the question. What is the value? 40. Can you
40
see?
million.
Now, all of this information here, this is what we call the book value. Book value that does not include the current market value condition. That does not include the current what? Market value. This is what we call a book value. Right? A book value. Now, if this is 40, this is the value. This is the book value. This is the nominal price. Class, what is the market price? What is the market price?
1.05.
1.05.
Okay, 1.05. Good. 1.05. Good. So this is 40 divided by, what is the nominal price?
0.5.
0.5.
0.5 times the market price. What is the market price?
1.05.
1.05. Please, it is not all the time that question will come in form of debt to equity ratio, debt divided by debt plus equity. You sometimes the examiner may test your knowledge on how to determine the total what? Market what? Value. So what do we have here?
84 million.
84 M. The tax rate is 20%. So let's check out for the value of debt for ZECO. Let's check. Okay. Let's check. ZECO PLC loan notes are quoted. When they say something is quoted, that is the market price. That is the current market price of either that loan or debt. Now, they quoted at 65 naira per loan note. And both the loan notes and the bank loan are secured. Class. And this will take us to capital reconstruction, where when a company wants to liquidate, they have to share what they have based on the Bankruptcy Act. We'll get there. Secured, unsecured, preference shares, ordinary shares. No, there's a way they arrange it. We'll get there. Before the ordinary shares, in line with the Bankruptcy Act, because that is what it is required. Then when they say a company loan is secured, meaning that you will pay me, whether you will pay me back. There is secured because probably I borrowed 50,000 from Christy, right? And I said, oh, don't worry, I have one blending, maybe in FCT, right? So don't worry, we'll use it. So that means that the loan is actually secured. That is a secured loan, right? That is a secured loan. So with that, ZECO PLC loan notes are currently quoted, and both the loan notes and the bank loan are secured. Because both of these loans are secured, class, because both of these loans are secured. If you want to determine the value of debts, don't forget there are two loans there. The first one is loan notes, which is the long term. The second one is the bank loan, which is the short term. But both are secured. Now, we should not forget, class, if you want to determine the value of bank loan, how do we determine the value of bank loan? Value of bank loan is what?
Bank loan does not have a market value, so you just keep the figure.
That means the book value of a bank loan becomes the market value of the bank loan.
Exactly.
Class, the book value of the bank loan becomes what? The value of the bank loan. One. Now is loan notes. Since we were given the currently quoted, you can see where the examiner wants you to, like, okay, let's see how you will arrive at your value of debt. Is the combination, your value of debt is the combination of your loan notes is debt. If you have preference share, you had it. If you have bank loan, you had it. All of these add their market value together. They becomes the total market value of that debt. Class. So currently quoted, the price is 65. Loan notes, the book value of the loan note is 250. The nominal value is what? Is 100. So currently quoted 65 naira. 65 naira. Oh, where is this thing now? 65 naira per loan notes. What is the value? What is the book value? 250, right?
Yes.
Yes, sir.
Divided by times 65 naira per loan notes. What do we have?
162.5.
152.5.
52.
62.
162.5.
Okay, 62. Okay, that's fine. This is, oh, let me arrange it this way. This is not how it should be. This will be loan notes equals to, yes, then bank loan. If you have any other loan again for the main company, add the market value together. All right, add the market value. So the market value, the book value of a bank loan is the market value of of that bank loan. So what is the book value? 20, right?
Yes.
So what is the total value of debt?
182.5 million.
182.5 million. Right? 182.5 million. Right? 182.5 million. So this is the total value of debt. What do we have again? I think we are good now. We are good now. Okay, please take notes. This is very important, right? What next? What next? Okay. Okay, we have to bring in this formula here. Okay. So BA, class, what is the BA? What is the BA?
0.94.
0.94. 0.94. This is 0. Value of equity, 84. Value of debt, 182.5. Tax. All right. So what do we have? Don't forget I will smooth this first. All right.
2.54.
So don't forget. Okay, let's check 0.94 plus. Give me the figure. What do you have here altogether? I mean, final figure like this. What do you have?
1.64.
1.64.
64.
When you add it together, what do you have?
2.58.
2.58. Equity better. Right. So after that, right, step 4. Projects. We'll stop here, right? Because the question says project specific costs of equity. All right. Project what? Project specific cost of what? Cost of equity. So you go back to our formula for calculating equity, cost of equity, which is CAPM. What do we have? KE. What is the risk free?
4.
4. Thank you. Plus 2.58. What is the market return?
10.
10.
10 minus 4. So what do we have? What is the cost of equity? Risk adjusted cost of equity?
19.48.
19 point what?
48.
48. Now I want to also, we need to pay attention. See, one thing about SFM is when you solve, it has interpretation. Even only if the person knows it new, it has what? Interpretation. Now, if you look at it, this is a cost of equity, project-specific cost of equity that will be used to discount the project. You can see that it increases. Why? The current cost of equity without debt is 17.8%, without risk. Now, something should come to your mind, that there is a law or a principle that says that the higher the DCF, the lower the what? NPV. So meaning that if the company discount it with project-specific cost of equity, the NPV will reduce, of which it makes sense because that project has already include what? Risk. But if you use 17%, you give me the 70% will give you higher NPV than 19%, because the higher the DCF, the lower the NPV. Then what will be your advice to an investor? Or is it the investment is positive? No, it's viable. It's mathematical. Okay, they venture into the business and something's up. You'll be held responsible because you need to consider the risk. So when you consider the risk, it will reduce the return that the investor will take. Although the higher the risk, the higher the what? The return. Right. So if this is established, next question.
Yeah, that's was 1.64 is 1.74.
Okay. Oh. So
the answer is 2.68.
Oh.
It's not too. It's
Sir,
1.64.
it is correct.
I beg. Maybe later you check it. Okay. Thank you. So do something like this. Where is it, sir? Just stop for this. Multiply by what you have there. Okay, you get it. So the B part of this question is okay, referring to your calculation. I've answered the question already. Can you see? Referring to your calculations above, comment briefly on the view of the commercial director. Based on your calculation now, what is the view of the commercial director? Say, no, don't use project-specific cost of capital, a cost of equity. The finance director say, oh, use project-specific cost of equity. Class, of which we've analyzed that a project-specific cost of capital will be suitable. Cost of equity will be suitable because it actually includes the risk. Right? It has considered the risk of the new business, why the other did not actually consider that. Right. So that's it, 2 marks. So discuss 3 problems Zeco PLC may be facing as a result of its current high level of gearing. Class, these questions, this particular B, the B part of this question is for you. In fact, the B and C, discuss the problem. When a company is faced with the current may be facing as a result of its current high level of gearing, what are the problems? Class 1, 2, what are the problems?
Number 1, it will reduce the market value of the company.
1, 2.
Yes, number 2. Such company
The
is
dividend.
tending towards liquidation.
Liquidation. Okay. 4.
The dividend payout will be low.
It may be denied of
5.
access.
Okay, not too much. Let's move on. So the next question. It is what it is, actually. So that is just what they want you to like tell us, right? Tell us, right? In respect of both equity and debt, in respect to equity and debt, discuss risk-return relationship and how it affects ZECO PLC financing costs. And this question is also for you. Tell us. You've calculated, you have calculate cost of debt. No, we didn't calculate cost. You have equity. Okay, we actually have debt now. We actually have debt. Okay. Can actually calculate. Now, we actually have debt. Okay. Now, the question says, in respect of both equity and debt, discuss the risk-return relationship and how it affects ZECO PLC financing cost. Class, the question, the examiner is saying that explain to us first equity, explain to us debt. Tell us, you tell us the risk as an equity holder. The debt, who will take higher return between the equity holder and debt holder? Equity.
Equity, yeah.
Debt lower. Is that not so? Now, how does it affect ZECO financing cost? Meaning that if the company goes with equity, the company finance or the capital structure, if the company goes with equity, the company costs of capital or cost of equity will increase. Why going by debt, the company cost of equity debt will be what? Lower, right? Is that not so? However, the cost of equity is usually greater than the word debt. If you want to prove this point, you already calculate the current cost of equity of 17 point something percent. Calculate the cost of debt, then use it to tell them that, oh, this is if the company goes by what is it called? Equity. The company will incur more costs. Why? By debt. The debt of the company or the finance, the debt or the capital structure of the company will reduce as a result of the debt, because the cost of equity is usually higher than the what? The cost of debt. Then you prove it. How do we determine cost of debt? Interest 1 minus tax rate divided by the market value. So now let's prove it. We can prove it. We can prove it, right? We can prove it. All right, we can prove it. So let's quickly check something. Let's quickly check something. The cost of debt, right? Interest 1 minus tax rate divided by the market's price, SD, right? I say SD, so very interest rates. It's fine. But we want to actually prove something here. Interest. So let's check. This is the last question. I think B part of it. C. C. Okay. So what is the interest rate attached to these debts? Irredeemable debt, right?
6.5.
6.5. Right. So the interest rate is 6.5. The tax rate is still remain 20%. Right. This is for the loan note. This is the current price of 65 naira per what? Per loan note. So you can use that to prove that this is how it will actually affect the company. Let's check it. So interest rate 6.5. 6.5. We can convert 6.5 to naira. interest 6.5 divided by 100 plus 6.5 divided by 100 times what? Times what?
Times 100.
100.
A nominal value. Good. So this will be 6.5. 6.5. Good. So just to prove something. We need to move, but then let's quickly do something here. So if this is 6.5 minutes, 6.5, the 1 minus tax rate is 20%. The market value as interest 65. 65. So what is the cost of irredeemable debt?
0.08.
0.08 or 8%.
8%.
Can you see the difference? And the current cost is about 17%. So this, as a result of having high equity, cost of equity, right? It will what affect the finance because they have to pay back. It is not mandatory though. They have to pay back their investor if they want to still be in the market. If not, their market price will keep declining as a result of this. So that is the proof actually. So thank you. Are we good? So we can move. Ibrahim, quickly.
Okay, thank you very much.
We have
There's
question 3.
something, there is something I want to actually, understand here. Though they didn't say that we should determine the WACC, only the cost of equity. Is that the reason why they didn't extend that debt portion like to become a redeemable debt? Is that the reason why?
No. It's not. If the examiner say you should determine a project specific cost of equity, do you know what it means? We'll get to adjusted present value. Now, that means that the project is only financed by equity. It's just equity. Don't forget that the C part of this question says the financing of Zeco PLC, the company. It's talking about the company. The B part is talking about the company. The A part, the first part, the second part is talking about the new venture. That means that the new venture will only be financed by equity. That means the sources of finance for that business, for that new venture is equity. So that is the reason why we didn't need the WACC, because the WACC will include both equity and debt. Do you get?
Yeah, yes, I do. Yes, I do.
Yeah.
Please, I have a question.
Okay.
The C part of the risk return relationship. I don't really understand that.
Have you been in my
the
class
question.
before now? Have you been in my class in
Yes.
cost of capital? Did you
Yes,
start
yes.
cost of capital with us, like cost of capital, where I explained the reason why cost of equity usually higher than the debt? Did you start it with us?
Yes, I did.
Please go back to the you can check the YouTube. Go back again. You will understand the risk relationship between the equity and debt. You understand? If I start that explanation now, we have it already. So equity and what and debt. I've explained it. Explain what is equity. When you say equity, an equity holder will take what? A higher risk, the lower risk of the debt, right? What is the return? An equity holder will take higher return. Why debt holder will take what? Lower return. That is what this is. Then the next thing is, how does it affect the company? How does it affect it? And the C part, that is the proof. Bring out the current cost of equity. Calculate the debt. Then now tell the examiner that, the cost of equity usually higher than this. which gives about this. Is that not so? Then talk about the debt. That the debt is what it is. So therefore, as a result of increase in the cost of equity, it may affect the company what finance. Do you get? So if you understand the concept of equity and debt, you should be able to like move on with that. Do you get? So I'll just advise you to like go back and see how it actually works. Thank you. So next question. Who is that?
Yeah,
Yeah, good
so the
evening.
other time you said the higher the risk, the lower the net present value. Like I wasn't sure if I got that right. I wanted to confirm.
The higher the DCF,
Okay, thank you,
right?
sir.
Which is the discount, the cost of the
Okay,
higher. If you increase it, what will happen to your NPV? Your NPV will be lower, will reduce.
okay. Thank you, sir.
Mhm. That's You're welcome. Okay. So I have another question. I think we've solved a part of this question in class already under the cost of capital without risk. Eco PLC. I think it's one of the past questions. We've done the A parts. Should we do the B and C part of this question? Then on Saturday, we'll do a fresh question on project specific. Like this question now. Yeah, it's also mm, are we still together?
Yes, sir.
Yes,
Yes, sir.
Okay, good. Okay, that's fine. Okay, okay. Well, we can just should we solve this 10:09, right? Just 1 hour. We just spend an hour. Can we finish this question? Question 4. Um, or we do just this question 5. Okay, let's just solve question. Let's do question 5. Question 4 include what is it called? Will include bond, cost of capital that leads to bond. We can't solve this now until we treat bond. We can save this question for bond. Then question 3. There are some questions here that they are not meant for. We'll not solve some of them in class. So intensive class, we'll do some of these questions in intensive class actually. Sadeco, we've done this already, right? I think we did that under cost of but I cut some parts, right? So I added the project specific, the diversification. You can do it. Okay, so let's quickly continue with our lecture. Eco PLC. Let's do Eco PLC here. So if you check this question, for those who are just joining us, we've done it before under the normal cost of capital without risk. Or we did these two, just these two parts, right? You can check the YouTube is there. So what I will do is to just focus on the B part. All right, is to focus on the B part, then B, C, D, E. Right. Okay. Using the capital asset pricing model, calculate the costs, calculate the cost of equity that should be included in a WACC suitable for appraising the project and explain your reason. Using the capital asset pricing model, calculate the cost of equity that should be included in a work suitable for what? Appraising the project. We don't know the project. Maybe it's a new project or old project. We don't know. The next question, we've done this before. Just check cost of capital, I think by 2. Oh, yeah, by 2. So, C, but by calculating an overall equity and using the CAPM, estimate the overall work of ECO, assuming that the project goes ahead and comments upon the implication of permanent change in the overall mark class. The B part of this question says you should calculate the cost of equity that will be suitable to calculate work, meaning that appraising the project, meaning that we had to stop at one stage. We don't know the project. Is it a new project or old project? We don't know. Then the C, we should do what? By calculating an overall equity better. So we should calculate overall equity better. So when we calculate the overall equity better and using the capital asset pricing model, estimate the overall work. We'll calculate the overall equity better and using the CAPM. So when we calculate the overall equity better, we'll now use the CAPM to estimate the overall what? Work. Assuming that the project goes ahead and comment upon the implications of a permanent change in, that is another 5 marks. Discuss whether ECO should diversify its operation and how the stock market might react to the proposed project. All of this, we'll think about it together in class. We'll discuss it, right? To diversify its operation. Definitely the company wants to diversify. That's just it, right? Discuss whether ECO should diversify its operation. What will be your advice? And how the stock market might react to that. E, identify the appropriate projects appraisal methodology that should be used when a project finance results in a major increase in the market in a company's market gearing ratio, and using the data relating to ECO calculate the project discount rate that should be used in these circumstances. Okay, 3 marks. Okay, we've done the first one. Okay, B. Please, can someone read Inca PLC?
Yinka PLC is a listed company in food retailing sector and has large stores in all holiday travel shops in all of its stores. At a recent board meeting, the directors discussed how the holiday travel shops' current weighted average cost of capital should be used to evaluate. The director disagreed because the existing cost of equity does not take into account the systematic risk of new projects.
Hold on. Thank you. Hold on. Can you see? Now, there is an argument again. Between the director and the board. One person said, oh, they should use the existing work. The directors says no. This work for the cost of equity does not include systematic risk of a new project. So why are we going to use it? You can go ahead, please. Go ahead.
Oh, sorry, I was muted. He said that the company's overall work, which reflects all of the company's activities, would change as a result of the project's acceptance. The board was also concerned with the market's reaction to its diversification plans. Another board meeting was scheduled at which Yinka's advisors would be asked to make a presentation on the project. You work
Okay.
for
Okay. Now, the board is also concerned. It's not just the risk. They're also concerned about what are they into first. Inca PLC is a listed company, right? We can see them in the what? A minute. Okay. Where are we? Okay. So the body is also concerned about the market reaction. Okay, the company is a listed company in food retailing sector and has large stores in all holiday travel shops, in all of its shop. Okay, is into food retailing and has what? Large stores. Okay, so the body is also like they are concerned about the market reaction. Will people what accept these products? Now, you work. Okay, you can go ahead, please.
Okay. You work for Yinka's advisors and have been asked to prepare information for the presentation. You have established the following. Yinka intends to raise the capital required for the project in such a way as to leave its existing debt to equity ratio by market value unchanged following the diversification.
Thank you.
Extracts, okay.
Okay, now Inca PLC intends to raise capital required for the project. Of course, they have a project. They will call investors now to say, okay, this project is viable. They should, it's part of how they will raise capital. And they are now considering that, okay, even if we want to raise this capital, the existing debt to equity ratio, that is the market value of equity, debt to equity, should remain unchanged following the what? Diversification. Okay. So we have extract of information, right? Okay. Go ahead.
On the May 31st, 2017, Yinka's ordinary shares had a market value of 276 kobo XD and an equity beta of 0.60. For the year ended May 31st, 2017, the dividend yield was 4.2% and the earnings per share was 25 kobo. The return on the market is expected to be 8% per annum and risk-free rate is 2% per annum.
We've done all this. Okay, go ahead.
Yinka's debentures had a market value of 108 naira ex interest per 100 naira nominal value on May 31st, 2017, and they are redeemable at par on May 31st, 2021.
Okay, thank you. So please, if you are just joining us for the first time, please you can check cost of capital. I think part 2, right? You will see it there, right? We solved this the A part of the question, right? Okay, go ahead.
Companies operating solely in the holiday travel industry have an average equity beta of 1.40, an average debt to equity ratio by market value of 3 to 5.
Okay, now hold on. Can you see that? Companies operating solely in the holiday travel industry. So meaning that this company, they are into just food retailing sector, and they now want to diversify into holiday travel. Holiday travel. And that is the reason why the examiner gave us information. Let me give us information that a companies solely in the holiday travel industry have an average equity beta of what? 1.4. A similar company. And the debt to equity ratio is 3.5. So meaning that the market value of debt is 3. The market value of equity is 5. That is what it means. It is estimated that if the project goes ahead, the overall equity beta of Inca will be made up of 90% food retailing and 10% holiday travel shop. That will be 100%. Meaning that if they want to go ahead with this project, food retailing will take the equity beta, the risk will take, the food retailing will take 90%, while the holiday will take 10%. Meaning that even the food retailing that they have before service is a very risky, what is it called? A business. The income tax is given as 20%, right? So the first question here, we've done the A, Roman figure 1 and 2. Now B, using the capital asset pricing model, calculate the cost of equity that should be included in a WACC suitable for appraising the project, and explain your reasoning, right? So suggested solution, suggested solution Inca PLC B. So what is the required of the question? Cost of equity for the new projects plus the cost of equity for the new projects. So that means we cannot just say, oh, risk-free is this. No, we have to start from the beginning. We have to identify the project company, but they just said a similar a company's operating solely. We don't know the name of the company, right? We don't know the name of the company. Please, your assignment will be this Sadeco. Yes, Sadeco. You've done the A part, then please do the B and B, C, D. This is 30 marks. Please, all of these questions are examinable questions. Very, very important, please. Okay. So, where are we? Oh, is it okay? So now, okay. Step 1. Quasi company Step 2. Right. Step 2. We'll have to check. Come in. Here. So, better debt for the policy company. Is there anything better debt for the policy company? Is there any? This is just the information for policy, right? Is there any better debt? No, right?
No, sir.
So, we go with the first one, right? Okay. So, I think by next week, we should start investment appraiser. Yes, investment appraiser. That will be next week. So BA. What is our BE? What is the value of equity? What is value of debt? What is the T? Okay, let's check. BE. What is the equity beta? What is the equity beta of the policy company?
1.40.
1 point what? 1.40. Right. 1.40. Class, are we tired? 1.40. What do anything? We'll not even start. So the VE. What is the level of gearing? Debt to equity, right?
Yes, sir.
3 to 5.
3 to 5.
So we can have 3 to 5. All right. Level of gearing, debt to equity. Debt is 3, equity is 5. So what is the tax rate? What is the tax rate given to us? They just give us, assume that
20%.
20%. So we'll use it for the 2, right?
Yes, sir.
We'll use it for the 2. So 20 what?
Percent.
20%. So VE, value of debt, tax rate, value of equity. Hamza, are you still in this class? So what do you have? BA. So what do you have?
0.95.
0.95. BA. Is it BA? Oh, sorry. Is it BA? Okay, 0.95. Okay. 0. What? 0.95. So what is the next step? Step 3. Step 3. Oh, think step 3, right? Okay. Our BA here is what? 0.9. So we have better debt of the main company. Let's check. Do we have? What is the value of debt of the main company? What is the value of equity? What is tax? And don't forget that we already told that they want to venture it into the what is it called, in such a way that their debt to equity ratio will remain what? Will remain unchanged. Where is it? Okay. The existing debt to equity ratio will remain what? Will remain unchanged. Class. If they want to venture into this, they want to ensure that, oh, their existing debt to equity ratio by market value remain what? So the question is, how do we determine? Oh, we've done that before. Oh, market value of debt and market value of equity. Okay, that's fine. We can pick it from here. So, better debts. I don't think is any figure for better debts of the main company.
No, sir.
No better debt, right? So, we have this. Are you the only one in this class? Anyway, okay. Oh,
We are here, sir.
okay, that's fine. Now, market
Yes.
value of for the debt. We should not forget how we normally calculate the debt. Is that not so? Now, what are the debts here? Redeemable and what? The
Bank loan.
long-term bank loan, right? The redeemable debenture and long-term what? Long-term bank loan. Good. If you look at it, this will be the value divided by the nominal price or the nominal value times the what? The market what? The market price. This is the debenture class, so 1,900. This is talking about the debenture divided by the nominal value, which is 100 times the market value as interest. The market value as interest is what? 108. Please, a minute. Hello, sir.
Hello.
A minute, please. A minute. Okay, are we still together? Sorry, please.
Yes, sir.
So we move, right? We move. Okay. What is the value from the capital structure? What is the value
Two
for the
two zero
venture?
five two. 2,052 million.
2,052.
052 million.
Right. Thank you. divided by the nominal value, which is 100. Check your notes. We've done something like
That's
this.
the total. That's the
No, sir,
total.
that's the figure from the
Market
calculation.
That
market
is the
value.
total.
We want to determine the market value of debt.
Then for starting
What is
afresh, that's 19.
what is the book value?
16. 16.
What is the book value of debenture?
1,900.
1,900. 1,900 times the market 108. We've done this before. Please check your notes. So what do we have? What is the market value?
2,052 million.
2052 million.
2052
Million.
Okay. We have other debt there. We have another debt there. Let me check.
We have bank loan.
We have bank loan, right? What did they talk about? What is the bank loan? No information. They just give us the bank, okay? Okay, no information. So bank loan, this is the bank loan. So the book value of the bank loan becomes the market value of the bank loan class. It is 635. Please, who is that? The person she meets is Michael. So bank loan. If you have preference share, still had it, right? It's part of what? Debt. So what is the book value?
635.
6 what? 635. So what is the total? Total
2687.
value
2687.
of debt. 2680.
87.
87.
2687. Is a million. Class, are we good?
687.
2687.
Oh, just
2,687.
87.
2687. Okay.
There's a late comer, please.
So if there is late comer, what should I do? I should start from the beginning.
Or just to let me copy what you are writing, the
No,
solutions.
you can do that in your YouTube. You can download it actually. So the next one is, if you have this to be the market total value of debt. Who is that now? Who is that? Can the person mute his or mic?
Tiami, you Abiodun, please mute your mic.
Thank you. So if this is the value, so if this is the total value of debt, so our 20% still remain 20%, right? So the value of equity. What is the value of equity? Value of equity, right? The ordinary shares are the market value. This is SDIV, right? Market value SDIV. That is what we need. We've done that before, right? You can check cost of capital, that's one, right? Or pay 2, yeah, pay 2, yeah. You see it there. So the ordinary shares are the what? Are the market value of what? 276 cover as what? As div. That is what we need because we want to determine the value. So the book value of equity, the book value of ordinary shares is 233, while the nominal value is 10 cover, right? Okay. So let's move. Okay, give me a figure. What is the book value of equity?
233 million.
233.
233 divided by, what is the nominal value?
0.1.
0.1. Thank you. So convert that one. What do you have? 276. That is what?
2.76.
2.76.
2.76. We've done this before. Can check cost of capital part 2. Okay. If you have something like this, the reason why we convert to Naira is because this is already in Naira, right? So we just want to be consistent, right? We just divide 10 kobo divided by 100. 276 divided by 100, you have this. So what is the market value of equity?
6431.
6430. Okay, 6431.
6431. 6431. 6431. So what next? Okay, the BA is 0. What? 0 BA 0.95. Right. So we are good now. So we need to bring all of this. All right. So BA 0.95. 0.95. Beta debt is 0. Value of debts, total value of debts is 2687. The tax rate is 0.2. The value of equity is what? We just calculated it. Okay.
6,431.
Thank you. 6,431. This is 1,431, right? So what do we what do we have?
1.27.
Tell me you. I will. Okay, don't worry.
1.27.
1.27.
Okay. Madam Victoria, are you still with us? No.
Yes.
1 point. Okay. 1 point what?
27.
27.
27. Okay, good. So the next step 4, because what they required says is that using the CAPEMO, calculate the cost of equity that should be included in a WACC suitable for appraising the project. That is a new project. And explain your reasoning. When you want to explain your reasoning, you can say that, okay, the project specific specific cost of equity include the risk of the new business. That's it. Right. We may likely continue on. Okay. So our class on Saturday is by 1, right? I think 12. Is it 1 or 12?
12 p.m., sir.
No. It's 1. It's 1. Yes. I'm supposed to change. Is it 12? I'm supposed to change that since I forgot actually. So please, yes, we'll maintain because we have a FR 10 to 12. So we'll just do like 12:40. Let's just do 12:40. By 12:40 we'll start. Yes, 12:40 on Saturday. So cost of equity, the risk free. What is the risk free?
2%.
2. Then 1.27. I remember last diet, there was a time we started the class, I think around 9 to 2. Is it 9 to 2 or 9 to 3? So we've not started anything though. This is just so market return. What is market return?
8.
8. 2. Right. By next week. Yes. So what do we have here? What is cost of equity?
9.62%.
9.62. If you check the suggested solution, if you look at how I solved the first part that we did under the cost of capital without, you will see that we check the solution in a different form, like the approach. If you still check this one too, it will be different. You see, you just need to understand, like, just understand what you want to do. When the examiner just follow the instruction they required. So I so much believe in required. When you understand the required, you can be able to solve the question. Please focus on the required. And that is the reason why Mr. A will come back. We say, no, I have a reference in SFM. Why now? I know this. I saw the question. Did you read the required? Did you follow the instruction? When the examiner say A, you are doing B. Then you now come and say, I kill in SFM. It's not like that, so it's not like that. So we have what? 9.62%, and that is the answer to the B part of the question. So, and explain your reasons that it is because the cost of project-specific cost of equity include the risks of the new business. Finish, right? You take your 5 marks, you move on. Next, by calculating an overall equity beta and using the CAPM, estimate the overall work of a assuming that the project goes out. So we need to estimate the overall work of a assuming that the project goes ahead, assuming that they want to go ahead with the project. Now we have to calculate the work. But before we calculate work, by calculating an overall equity beta, the question is, how do we determine overall equity beta? Now you should not forget that in this part of the question, we're told that it is estimated that if the project goes ahead, the overall equity beta of Ican will be made up of 90% of what we had here. Where is the equity beta of this company? Where is it? 0.60. Meaning that if the project goes ahead, 90% we go for food retailing. 10% we go for travel. Don't worry, under the adjusted cost of capital, we'll do more of all these things, right? But just have the understanding here, right? 90% for food retailing, then 10%. Now, don't forget that the company wants to go into holiday travel shops, which will take about how many percent? 10%. Which will take about what? 10%. So in this case, the examiner is now asking us that, by calculating overall equity beta and using the CAPM, estimate the overall work of a assuming that the project goes ahead. Now they want to go ahead with the project. So we will need that. So in our next class, we'll continue. In our next class, we'll start from the C part of this question. Right? After we solve the C part of the C, D, and E, right? Thereafter, we will now solve this question on project-specific cost of capital. Class, by the time we are done with these questions on Saturday, please, you should be able to check past question. You solve project-specific cost of capital or cost of capital, like, conveniently, because I've given you all you need to see, all you need to know under this project specific cost of capital or the project specific cost of, except the parts of where we have bond in cost of capital. And I said that before we can treat that questions, which is this question 2, we need to treat bond valuation. So when we treat bond valuation, we come back and take one of these questions. Then the other questions will now be in what? In intensive class. Your assignment, question 4, complete it. You've done, I think I've acknowledged this question 4 before, Sadeko, right? I'm here to review the last assignment. I will do that immediately after this class. I think I will use like 10 minutes to 20 minutes to do that. Then complete the B part of this question, C, D, so that you will not see it. You will not say, I think I saw this question. Yes, I know this question. No, it will not happen. No. Even only if you listen to what? Instruction. Sadeko, the last one, complete the project specific cost of capital 1. In our next class, I will complete this question on Eco PLC. Then we'll solve this question, which is question 4. Then we are done with project specific cost of capital. Our next class, which is on Monday. Is it Monday? Oh, no. Which is on Saturday, yes.
On Saturday.
Saturday, Sunday. We'll complete the project specific cost of capital on Saturday. Then Sunday, 9. Then we'll move to another topic. Maybe if we complete that one on Saturday, then Sunday, another topic, which is what? Investment appraiser. Distinguished professional colleagues, I know, last diet, I knew that value added, economic value added will come. Yes, I know. Because I actually mentioned it in class. That you see, this part of valuation of a business, it's been a while that I can test this. Most likely, but I will not take it in class. But please, go back to your ever. I mentioned it. Go back to your ever and solve just one question on it. Now, the same thing applicable to investment appraiser. Investment appraiser, there are 2 parts that Ican is here to test question on it. So they just say, okay, Mukona, they play. Then when you now say, investment appraiser. 1, the part of lease, if you check, I think for 4 to 5 diets now, no lease question. 1. Another one is replacement theory. For 3 to 4 diets, no replacement theory. 2, recently, decision tree, they brought that one. We'll still treat all of these things under the investment appraiser. I know it will take us, I know we'll spend more time. Sensitivity analysis, we'll cover all of those things under the investment appraiser. You don't need any textbook. I used to say it. See, the only thing you need is for you to be consistent. 1, make sure you go back and watch the video. 2, get your material if you have the capacity. Thereafter, you are good to go. Class, thereafter, you are good to go. I've done the research work already. It's just for you to do what? Just go back, study it, and we are good to go. Thank you so much, everyone, for joining. Any question before we go, please? Question? Okay. Question? Okay. Go ahead, go ahead, go ahead. Quickly, please. I need to go. I need to go, please. Go ahead. Chineme Miracle, right? Go ahead. Okay. I think there's no question. So thank you so much everyone for joining, and enjoy the rest of your evening. Bye for now. See you on Saturday at what? At 12:45 p.m. Bye for now.